So picture this. It's Friday, August 7th, 2026.
Right.
And the U.S. economy unexpectedly loses 23,000 jobs.
Which, to any rational observer, that's a terrible headline.
It's awful. I mean, it signals contraction, hardship, maybe even a recession. But on that exact same day, Wall Street just throws this massive, unbridled party.
Oh, yeah, an absolute rager.
The S&P 500 surges to an all-time record high of 7,757. And, today in this deep dive, we are going to tear into a massive stack of analyst notes, economic indicators, and foreign exchange reports to figure out how that happened.
Because it makes zero sense on the surface.
Exactly. How does objectively bad news become the ultimate good news? We're going to decode this secret currency intervention that prevented a Monday meltdown. We'll explore this bizarre Goldilocks labor market, and we'll look at why this late summer market celebration might actually be, well, a giant algorithmic trap.
Yeah, and the milestones we saw this week were genuinely historic. I mean, beyond the S&P crossing 7,750 for the first time, you had the Dow soaring past 54,000. And the Nasdaq, it gained a massive 3.00% in just 5 trading days.
Which is wild. But to really understand why the market was even in a position to celebrate those job losses on Friday, we kind of have to rewind, right?
We do, because the euphoria of Friday simply does not happen without the quiet, systemic disaster that was averted the weekend prior.
Right, you're talking about Friday, July 31st.
Exactly.
Because looking through the international cross-asset flows from that weekend, it's really clear that if the U.S. and Japan hadn't pulled this highly unconventional maneuver, Monday morning wouldn't have been a record high.
No, it would have been a bloodbath.
Yeah.
An absolute bloodbath.
So what actually happened?
Well, a coordinated global market collapse was entirely on the table. The Japanese yen was facing this intense, speculative downside pressure.
Like short sellers just attacking it.
Yes. Short sellers were aggressively driving the currency into the ground. And if the yen had been allowed to break key psychological support levels, the cascading effects would have been catastrophic.
So what did they do?
So the U.S. Department of the Treasury, executing through the Federal Reserve Bank of New York, teamed up with the Bank of Japan for this incredibly rare joint foreign exchange intervention.
But the mechanics of this intervention are what really stand out in these reports. I mean, usually when you hear U.S. currency intervention, the immediate assumption is, oh, the Treasury printed billions of dollars.
Right, or they pulled liquidity out of the domestic system to buy yen.
Exactly, but they completely bypassed the U.S. dollar, like entirely.
And that is the absolute brilliance of the execution. The U.S. Treasury opted to sell euros from its existing foreign currency reserves to purchase the Japanese yen.
It's essentially a corporate asset swap.
Yeah, that's a good way to look at it.
I mean, we have this analogy in the notes that I love. Let's unpack this for you guys listening. Imagine your piggy bank has blue tokens. Those are euros. And red tokens are yen, and green tokens are U.S. dollars.
Right, I'm with you.
So the red tokens are losing power, and it's making everyone panic. So you trade some of your blue tokens for red tokens to help out. But notice what you didn't touch.
The green token.
The green tokens. The U.S. dollar wasn't manipulated at all.
Yeah, it's like a company paying off a toxic high-interest loan by selling an unused warehouse rather than, issuing new stock and diluting its shareholders.
Exactly. The U.S. de-risked the global balance sheet without diluting the dollar. They just swapped one foreign asset for another.
A perfect way to visualize it. Because by selling euros to buy yen, they altered the composition of the foreign currencies held by the government, but they didn't create or destroy a single U.S. dollar.
So no immediate impact on domestic liquidity.
Zero. No impact on the purchasing power of the dollar, nothing.
Which, okay, that begs the question, why was the U.S. so incentivized to rescue the Japanese currency in the first place? I mean, if the yen falls, Japanese exports just become cheaper for Americans.
Right. Usually, yes. But looking at the institutional positioning here, the fear wasn't about trade imbalances. It was entirely about the yen carry trade.
The yen carry trade. Let's dig into that.
So the yen carry trade is basically the hidden plumbing of global financial liquidity. Because the Bank of Japan has maintained historically zero or even negative interest rates for decades, global hedge funds and institutional traders borrow Japanese yen for practically nothing.
Like virtually free money.
Exactly. So they take that free money, convert it, and deploy it into high-yielding, high-beta assets globally.
And by that you mean U.S. technology stocks.
Yep. Tech stocks and U.S. Treasury bonds.
So they are literally funding Silicon Valley valuations with cheap Tokyo debt.
Precisely. But if yen suddenly plummets in value or becomes wildly volatile, the math on those loans implodes.
Because the lenders back in Japan start demanding more collateral.
Exactly. The volatility spikes the risk premium. If the U.S. and Japan hadn't intervened, the extreme short selling would have sent the yen over a cliff, and that would trigger forced margin calls across the globe.
Oh, wow. So to cover those yen-denominated loans, these funds would have been forced to just liquidate everything.
Rapid, indiscriminate liquidation of their U.S. tech stock.
And the selling pressure would have been entirely mechanical. Like, it wouldn't have mattered if a U.S. tech company had great earnings or not.
Not at all. The funds would have to sell just to cover their Japanese debt. We would have seen the Nasdaq open sharply lower on Monday, the VIX would have spiked, and the contagion would have spread back to Japan.
Probably crashing the Nikkei as import inflation surged.
Definitely. But by stepping in and buying the yen with euros, the U.S. Treasury projected this impenetrable wall of stability.
They just instantly burned the short sellers.
Oh, they torched them? Anyone betting against the currency was forced to cover their positions, which naturally drove the yen back up to a stable level.
So the panic was neutralized before the U.S. markets even opened for the week.
Exactly. And the relief in Asia was immediate. I mean, South Korea's cost speeds jumped 1.46%, the small-cap Kosdaq soared 3.0%, and the Nikkei rebounded heavily.
So when the opening bell rang in New York on Monday, August 3rd, the systemic international risk was totally off the table.
A clean slate.
A clean slate to digest the domestic economic data. And man, from Monday to Thursday, that data painted a highly complex picture of an economy trying to thread a very specific needle.
Yeah, analysts are calling it the Goldilocks grind.
Goldilocks grind. I like that.
Because the data was this constant push and pull. Monday kicked off with the ISM manufacturing report, which completely defied historical seasonality.
Right, because usually August sees a manufacturing slowdown.
Yeah, factories retool, European buyers go on holiday, stuff like that. But this report showed the strongest expansion since 2022.
Driven by what?
Sharp gains in production and new export orders.
Which sent the Dow to an immediate record high on Monday. But then the plot thickens on Tuesday.
Always does.
We get the Joel test report, the job openings and labor turnover survey. So we had booming factory production on Monday, but Tuesday showed job openings coming in remarkably cool.
Very cool.
Like 7.359 million versus the expected 7.44 million.
And that is the first signal of the cooling labor demand, the frantic post-pandemic scramble for workers. That's over.
Companies are just letting open requisitions expire without filling them.
Exactly. Yet simultaneously on Tuesday, we got Q2 earnings from heavyweights like AMD, Caterpillar, and McDonald's, and they showed intense resilience.
AMD proved that hyperscaler AI spending is still accelerating, right?
Yep. And Caterpillar demonstrated robust global heavy equipment demand.
While McDonald's showed the low to middle income consumer hasn't completely capitulated yet.
Right. But then Wednesday hits.
This is where the narrative starts to feel really contradictory. On Wednesday, the ISM Services PMI rises to 54.1.
Indicating strong expansion in the services sector.
Right. But the ADP private payrolls report shows companies only added a measly 44,000 jobs.
And then Thursday.
Thursday hits, and initial jobless claims are incredibly low at 199,000, but unit labor costs only rose 1.3%.
It's a puzzle.
It is. Here's where I push back. If businesses are booming, why aren't they hiring? And if they aren't hiring, how are they expanding? Aren't those two things totally contradictory?
They seem like it, right. But the linchpin connecting those seemingly contradictory data points is labor productivity, which, by the way, also dropped on Thursday.
Wait, really?
Well, the report dropped on Thursday. The data itself, Q2 non-farm productivity, actually rose by a highly impressive 1.4%.
Oh, I see. So workers are simply doing more with less.
Precisely. The output per hour is increasing. Companies don't need to hire the 80,000 workers they normally would because the existing workforce is covering the gap.
Aided by, what, new enterprise software, AI integration?
All of that, or just sheer operational efficiency. And that is why the unit labor cost metric of 1.3% is the most vital number in that Thursday batch.
Break that down for me.
Well, think about it. If productivity were stagnant and a company wanted to increase output, they would have to hire more people or pay their current staff massive overtime.
Right, which spikes unit labor costs.
Exactly. And to protect their profit margins, the company then raises the price of its goods, which fuels inflation.
But because productivity is up?
They are absorbing the cost of retaining their current workforce without suffering margin compression. They don't have to hike prices.
So that effectively kills the Fed's worst nightmare. The wage price spiral.
It absolutely kills it. It is the holy grail for equity valuations. You have low layoffs, evidenced by the 199,000 jobless claims, so the consumer still has money to spend.
Right.
But you have low hiring, so wage inflation is contained. Businesses protect their margins, earnings grow, and inflation cools. It is a masterclass in a soft landing.
Which perfectly sets the stage for the massive cognitive dissonance of Friday morning.
Oh, Friday.
Yeah, because all of that delicate, nuanced data from Monday to Thursday was completely overshadowed by the July non-farm payrolls report.
The shocker.
The consensus expectation was a gain of 80,000 jobs. But the reality? The economy contracted by 23,000 jobs?
And let's not forget, they wiped out a combined 103,000 jobs from May and June in downward revisions.
Right. And the unemployment rate ticked up to 4.1%.
On its face, a negative payroll print is recessionary data. Plain and simple.
But Wall Street reacted by buying everything in sight. The S&P 500 surged 0.6%. The Nasdaq jumped 1.3%. For anyone not steeped in monetary policy, cheering for job losses feels incredibly perverse.
It does feel perverse, but it comes down to the mechanical relationship between the labor market, inflation, and the Federal Reserve's interest rate levers.
Because the stock market functions as a forward-looking discounting mechanism. Right?
Exactly. For the last 2 years, equity multiples have been heavily suppressed by the higher-for-longer interest rate regime. High borrowing costs choke corporate growth.
And a 5% risk-free yield on a treasury bond makes equities far less attractive to institutional allocators. Why risk it in the stock market when you get 5% guaranteed?
Precisely. And the Fed has been crystal clear. They will not lower those interest rates until they are absolutely certain that domestic demand has cooled enough to permanently extinguish inflation.
And the primary engine of that demand is a tight labor market.
Right. So when the jobs report printed negative 23,000, the algorithmic and institutional models immediately flashed a signal. The labor market has officially frozen.
The threat of demand pull inflation is dead.
Dead. And this virtually guarantees that the Federal Reserve will aggressively cut interest rates at their upcoming September meeting. The bond market instantly repriced this reality.
Let me guess. Yields tanked.
Big time. The 10-year Treasury yield dropped to 4.64%, and the 2-year yield, which is hypersensitive to Fed policy, plummeted to 4.20%.
Wow. And as soon as those yields dropped, the discount rate applied to future corporate earnings dropped with them, instantly inflating the present value of the stock market.
It's purely mathematical.
But, looking under the hood of that 23,000 job loss, it's vital to understand that this isn't a systemic wave of corporate bankruptcies or mass layoffs.
No, not at all.
It's a structural, seasonal artifact.
The internals of the household survey tell a very, very different story than the headline implies.
Right. Because when you dig into the data, you see that 53,000 of those lost jobs were local government education cuts. Teachers and support staff rolling off payrolls at the end of the school year.
Yeah, that's a huge chunk right there.
I like to use the lemonade stand analogy.
Yeah.
It's not like the boss is coming out and firing everyone. It's more like a bunch of kids just decided to go home and play video games.
That's a good way to put it.
Especially when you look at the labor force participation rate, it dropped to a 5-year low of 61.4%. This isn't millions of people getting pink slips and lining up at the unemployment office.
No.
This is a demographic shift combined with a corporate hiring freeze. People are stepping back from the labor pool, and companies are simply refusing to add new headcount.
And that distinction between a hiring freeze and a firing wave is critical.
Hugely critical.
Because a firing wave implies distressed balance sheets and impending credit defaults. A hiring freeze just implies cautious corporate stewardship.
Right. And because the labor pool is static and demand for new workers is dropping, year-over-year wage growth slowed to just 3.2%.
Which gives the Fed the ultimate green light.
So, okay, the macro picture explains why the market rallied. But if we pivot to the sector-by-sector flows, we see that this money didn't just passively float the entire market equally.
Oh, absolutely not.
It was a violent, targeted rotation into very specific assets.
Yeah, the breadth was technically positive. The Russell 3000 gained 2.15%, and 10 of the 11 GICS sectors finished in the green. But the allocation was profoundly skewed toward high beta growth.
Like tech.
Especially tech. The technology sector, XLK, surged 5.58% in a single week.
And the subsectors were even more extreme. The Philadelphia Semiconductor Index, the SOX, exploded by 8.11%.
Huge numbers.
And the thematic AI indexes went entirely parabolic. I think the Nasdaq Artificial Intelligence Index jumped 4.62%.
And again, this is a direct mechanical reaction to the drop in bond yields. Technology companies, particularly those involved in capital-intensive AI infrastructure buildouts, are highly sensitive to the cost of capital.
Because they have to borrow so much to build those data centers.
Exactly. When rates drop, the mathematical models used by institutional asset managers dictate that long-duration growth stocks are immediately more valuable.
Combine that with the AMD earnings showing real, tangible hyperscaler demand, and you have a massive risk-on mandate.
But to fund that mandate, capital had to be drained from somewhere else.
Right. The defensive sectors were the designated losers of the week. Let's look at the numbers. Utilities fell 1.69%, energy dropped 2.19%. Real estate was basically flat, and consumer staples only managed a 0.31% gain.
Institutional money completely abandoned the recessionary safe havens.
So what does this all mean for the average portfolio? Is it time for our listeners to just go all in on tech?
Well, this brings us to the most critical structural warning from the analyst notes.
Oh.
Yeah. The fundamental macroeconomic narrative, falling inflation, resilient productivity, impending rate cuts, that's all supportive. But the actual mechanics of this specific week's price action are flashing severe warning signs.
Analysts are explicitly calling this a 6-day vertical melt-up.
Fueled by a volatility vacuum.
Okay, let's define that. Because a Shiller PE of 42.39 is historically terrifying.
It really is.
For those listening, the Shiller PE, or the cyclically adjusted price-to-earnings ratio, it averages out 10 years of earnings to smooth out the business cycle. A multiple over 40 has only been seen during the absolute peak of the dot-com bubble and the post-pandemic zero-interest rate anomaly.
The market is pricing in utter macroeconomic perfection.
And they are doing it in an environment almost completely devoid of human oversight.
Right, and this is where the volatility vacuum comes into play. The VIX, the market's primary fear gauge, dropped to 14.03.
Wow.
And the new V index, which measures bond market volatility, plummeted 10.50% down to 72.03.
So historical and implied volatility are just crashing. How does that mechanically force prices up, though?
Through systematic volatility targeting algorithms. A massive portion of modern market liquidity is controlled by quantitative funds that dynamically adjust their equity exposure based on volatility metrics.
Okay, tracking.
When volatility is high, their risk parity models force them to sell equities and move to cash. But when volatility drops, when the VIX bleeds down to 14, those exact same models mechanically force the algorithms to buy equities and increase leverage.
Completely irrespective of underlying fundamental valuations.
Completely blind to it.
So, because it's August, human portfolio managers are on vacation in the Hamptons or Europe, right? Trading volume is notoriously thin.
Exactly.
You essentially have an empty room, and in that room, automated models are aggressively hitting buy just because the volatility metrics tell them to.
Precisely. The algorithms are just chasing momentum in a low liquidity environment, pushing that Shiller PE to extreme levels.
And the structural danger here is that if a macroeconomic shock hits and technical resistance levels fail, volatility will instantly spike.
And what do the algorithms do then?
Those same algorithms will instantly flip from maximum leverage to aggressive liquidation. And because the human buyers are on vacation, the order book will be completely empty. There's no fundamental buyer stepping in to catch the falling knife.
It creates an air pocket, a classic bull trap. The market's stretched positioning makes it highly asymmetrical right now.
Meaning?
There is very little upside left to price in, but massive downside risk if the perfect soft landing narrative is even slightly disrupted.
Which is a perfect segue. You mentioned that tech valuations are sitting at a massive 42 PE multiple, assuming inflation is dead and the Fed will cut. But if we look at what happened in the commodities market this week, that assumption might be incredibly dangerous.
Oh, totally. The commodities sector was wildly disconnected from the equity euphoria.
It was driven by a totally different set of geopolitical realities. The divergence in real assets this week was basically a masterclass in global macroeconomics.
It really was. Take gold, for instance.
Yeah. The BCM Gold Subindex surged an astonishing 7.56% in a single week.
With bullion pushing past $4,350 an ounce.
Its best week in 8 months. And the mechanics here kind of mirror the equity market, but for different reasons. Because gold yields nothing, right?
Right.
When a treasury bond guarantees 5%, holding a non-yielding rock has a huge opportunity cost. But the moment Friday's job report printed negative and the 2-year yield cratered, That opportunity cost just vanished.
Exactly. The drop in real interest rates, combined with a broadly weakening U.S. dollar as Forex markets priced in those Fed rate cuts, it provided a massive tailwind.
So investors are hunting for real assets as bond yields vanish.
Yeah, sovereign wealth funds and central banks are utilizing gold as a primary hedge against the exact volatility vacuum we just discussed in equities.
But the real volatility was in the energy markets.
Mhm.
The weekly summary shows WTI crude falling 2.69%, but that singular number completely masks the violent intraday volatility driven by Middle Eastern diplomacy.
The energy complex this week operated as a real-time geopolitical barometer. Early in the week, Brent crude actually fell over 4.5%.
Due to diplomatic progress regarding maritime transit security through the Strait of Hormuz.
All right.
Correct.
Yes. The Strait of Hormuz is the ultimate global choke point. If passage is secured, the geopolitical risk premium baked into a barrel of oil instantly evaporates. Traders priced out the worst-case supply disruption, which eased inflation fears globally.
But
Then, by Thursday, conflicting intelligence reports regarding those exact negotiations emerged.
and the uncertainty triggered a massive 3.8% intraday spike in Brent crude. And this volatility created a really fascinating structural divergence between global and domestic oil, which showed up in the Brent WTI spread.
It did, because Brent crude ended the week basically flat, while WTI fell almost 3%.
The gap between them widened to $5.37. Walk us through the mechanics of that spread, because it tells a deep story about logistics and risk.
Sure. So Brent crude is the global benchmark. It primarily reflects waterborne oil that is highly exposed to maritime transit risks.
Got it.
WTI, on the other hand, West Texas Intermediate, represents inland U.S. production. That's oil pulled from the Permian Basin and stored in Cushing, Oklahoma.
So, because the geopolitical threat is specifically centered on shipping lanes in the Middle East, the risk premium attached itself exclusively to Brent.
Exactly.
While WTI, trapped in the U.S. pipeline system, actually suffered from domestic oversupply.
Correct. The market was essentially placing a tax on global oil while domestic oil was discounted. And for physical crude traders, a $5.37 spread creates a highly lucrative arbitrage opportunity.
Because it suddenly becomes wildly profitable to just charter vessels, load up cheap WTI from the U.S. Gulf Coast, and export it to European or Asian refiners desperate to avoid the Brent premium.
Geopolitical headlines literally redrew the physical trade routes of the global energy supply within 48 hours.
It's incredible.
Yeah.
Which brings us perfectly to the look ahead for the week of August 10th to August 14th. We have a stock market trading at a 42 PE multiple based entirely on the assumption that inflation is dead.
Right.
But we have an oil market that is one bad diplomatic headline away from spiking, which would instantly resurrect inflation.
And that's the danger.
So this upcoming week hinges on a barrage of data that will either validate this algorithmic melt-up or completely shatter it.
Wednesday is the crucible. We get the July Consumer Price Index, the CPI. The consensus expectation is 3.4% year over year.
And if that number comes in at 3.4% or lower, the algorithmic models are validated. The Fed has the all clear to cut rates, and the momentum continues.
But consider the inverse.
Yeah.
If the CPI prints hot, say 3.6% or 3.7%, driven by housing or lingering services inflation, the entire macro narrative implodes. The Fed cannot cut rates into rising inflation, regardless of how many jobs were lost on Friday.
So if the CPI prints hot, the market immediately faces the specter of stagflation, rising prices and contracting employment.
And in a stagflationary environment, a 42 Shiller PE is mathematically unsustainable. The algorithmic models would instantly reverse, selling equities to reduce risk.
Which would be brutal. Then Thursday brings the producer price index to test wholesale costs.
And Friday gives us the vital consumer health check with retail sales and the Michigan Consumer Sentiment Index.
Because we know job openings are down and wage growth has slowed to 3.2%, we need to see if the U.S. consumer, who drives 2/3 of GDP, is pulling back.
Right. And alongside all that macro data, the micro-level corporate earnings will dictate the sector flows next week.
Berkshire Hathaway reports on Monday, giving us a look at how Warren Buffett is deploying or, hoarding his record cash reserves.
We also have a slew of AI infrastructure reports. CoreWeave on Tuesday, Cisco on Wednesday, and the massive semiconductor bellwether Applied Materials on Thursday.
Oh man, Applied Materials. They literally manufacture the fabrication equipment required to build AI chips. Their forward guidance will be the ultimate reality check for that 8% explosion in the semiconductor index this week.
We will find out if the hype is backed by physical, capital expenditure reality.
It is arguably the most consequential week of the third quarter. The margin for error in asset pricing is currently zero.
Zero.
Well, we have dissected an incredibly dense week of market mechanics today.
We covered a lot of ground.
We did. You, the listener, now understand how a coordinated, stealthy US-Japan currency swap bypassed the dollar to defuse a global margin call bomb.
You've seen the underlying mechanics of a Goldilocks economy, where rising worker productivity allows companies to freeze hiring without sacrificing profit margins or spiking inflation.
You know exactly why algorithmic volatility models blindly push tech stocks to a 42 PE multiple in the wake of 23,000 lost jobs. And you understand how a simple geopolitical rumor widened the Brent WTI spread and reorganized global shipping routes.
The interconnectivity of these systems is what makes modern market structure so fascinating and currently so fragile.
Which leaves us with a final vital thought experiment as we head into next week. Right now, automated trading algorithms are betting trillions of dollars that the Federal Reserve will lower rates because the job market is cooling and inflation is defeated.
But what happens if the diplomacy in the Strait of Hormuz fails over the weekend?
Exactly. If global oil spikes back over $100 a barrel, inflation will surge through the supply chain immediately. If the Federal Reserve is suddenly trapped, forced to choose between fighting a resurrected inflation crisis or rescuing a contracting labor market, where does that leave an automated stock market priced for absolute perfection?
It is a scenario that thin August liquidity pools are entirely unprepared to absorb.
Something to think about. Keep questioning the headlines, look for the mechanics beneath the data, and stay vigilant. Thank you for joining us on this deep dive. Until next time.